Good afternoon, and thank you all for joining us today. My name is Sarah Bothner, and I'm here from the Capital ESOP Group at UBS alongside my partner Keith Apton. Our team leads the ESOP practice on behalf of UBS nationally. We're here with Brendan Richardson, co-founder of Liquidus Partners. We're very grateful to be a part of Rutgers' seventh annual Private Equity and Employee Share Ownership Symposium. Keith and I will be moderating our session today and really focusing on Brendan's group, Liquidus Partners. We're going to be asking him some questions about the innovative new strategies that his team is using to further the employee ownership mission with the use of private capital. So before we get started, I'll hand it over to Brendan to introduce himself and provide a little bit of background on himself, his career, and his practice with Liquidus.
Thanks, Sarah. Thanks, Keith. It's great to be here and really appreciate the opportunity to talk with you guys today. I'll keep my background brief. I spent 15, almost 20 years as a early stage venture investor in Silicon Valley and part of that time in Europe as well. Um, Became an entrepreneur later in my career, two-time entrepreneur, also venture backed, so raised approximately $100 million dollars of venture capital across those two companies. Sold the last one in February of last year. And my VC mentor, who I've known for 30 plus years, was on my board. He is also an impact investor. And when we sold the company, he said, "What are you thinking about doing?" And I sort of didn't really have a good answer, except that I really wanted to move back to the capital side, the capital allocation side. And he sort of just, with a wink in his eye, sort of said, "Why don't you go look at this ESOP space? I've been thinking about this for quite a while. It's really interesting and it's an interesting corner, and it seems like a real opportunity for capital innovation." And so I spent about 6 months going pretty deep into the ESOP world at the beginning, late 2024 and early 2025, and came away, as I think most people do, really impressed and really filled with questions about why such an innovative employee ownership strategy that clearly delivers good and benefit across all the stakeholders. Why aren't there more of them? Why isn't this a much bigger asset class, if you want to define it that way? And so with that, my partner Chester and I decided to start looking into raising a fund to finance ESOPs. And in that process, he had been involved early on with Apis and Heritage, one of the financing firms that are providing the subordinated debt and unitranche for ESOP formation. And we sat down with Todd and Phil, the founders at Apis and Heritage, and kind of had a couple long strategy sessions about the best way to enter the market. And they highlighted for us that one of the big barriers for owners deciding to go the ESOP route is that they have to finance it with a seller note typically, and that's a big consideration for a lot of business owners. And so we thought, and this is really Chester deserves the credit for this. He kind of sees around the corner, was like, well, that's where we should focus. We should focus on raising capital to acquire seller notes in great companies, and it's private credit. Private credit is hot, and if we understand the ESOP world and understanding how ESOPs work, we should be able to deploy capital into great companies, provide liquidity for the sellers, and become a trusted capital provider for those companies going forward for future things that they want to do, acquisitions, redemption obligations, so on and so forth. There's a white space there that nobody's filled. Let's go fill that and prove that you can make market rate returns there. And if we can prove it, then capital should flow in, and we shouldn't be the only fund. We should, open source our playbook so that there's lots of funds, 5, 10 years down the road doing the same thing. And there's going to be a lot more ESOPs. That's kind of all of it in a nutshell.
And Brendan, to state the obvious, why for a business owner does that matter? Like what's the value to a business owner, or what's the value to an advisor to a business owner as to the solution you have pairing with the seller notes? What's the value prop that you're creating to them?
Is that, and of course this isn't true in every case, and maybe not even true in most cases, but I think in some cases, a business owner has taken a seller note, financed that transition to an ESOP, 2, 3, 4, 5 years, maybe longer down the road. They're stepped away from the business. They are semi-retired or retired, but they're still kind of hanging around the hoop, making sure that that business is continuing to perform because they depend on it. That seller note is paying them back. And they would prefer to have liquidity. They would prefer to have cash now and go do something, take the kids to Disney World or the grandkids, I guess, to Disney World, or do something, diversify, and at the right price would prefer to turn that seller note into cash today. It's an opportunity for us to look at a seller note and either acquire that at terms or at a discount or refinance it with the company so that the company has, let's call it right-sized capital or institutional capital that can add value, and the seller can move on, and it solves for a couple different problems, at least in theory. And to be fully transparent, we are raising the fund as we speak. We are currently looking at deals. We haven't done a deal yet, but we're certainly looking at a lot. And every deal is a snowflake. And so some of this is going to fit and some of it's not going to fit.
So as you're raising the fund, how are you finding opportunities and what are your ultimate expectations for the overall market opportunity in this space?
Yeah, it's a great question. So I think one of the attractive features of looking at seller notes vis-a-vis perhaps financing the ESOP transaction at the outset is that we know where all these ESOPs are. The NCEO maintains a database of every ESOP in the country, and that database is easily sortable. You know where every ESOP is, and you have a pretty good idea. You can infer whether there's a seller note there. So we can find them. Origination is not necessarily the problem in an outbound way. But much more important to our strategy is referrals from groups like UBS, A&H, other groups, advisors, trustees that know the sellers, know the businesses, understand what we do, and make those introductions. And that's the deal flow that we're seeing today is entirely sourced from referrals from people that we trust that are already in the industry.
Got it. Let's kind of pivot into how you underwrite the deals, the specifics that you're looking for. When you underwrite the deals, like walk us through, like what are you looking for as far as the size of the note, coupon, total return, warrants, kind of just walk us through it. And you said earlier today that this fund is being raised and you guys are looking to cut the check, the first check. Let's all find reasons to bring you these deals. We all have
Yeah.
clients that need capital. But what's the total return that you're looking for and what's the ideal structure?
Yeah. Great question. So the target raised for the fund is 300 million. And that when you do the backwards math, that's about 10 to 15 deals of acquiring notes of 10 to 20 million dollars a piece. And how we underwrite these is exactly like any credit provider would underwrite a loan. We look at the company first. We want to find performing companies in great industries with strong histories of EBITDA growth and revenue growth, strong management teams, folks that are going to drive this business forward and upwards. If you think about this as a Venn diagram view, the next circle that overlaps is a seller that's holding a note with reasonable terms, maybe warrants attached, maybe not, but where we can engineer an acquisition of that note at a discount, perhaps, that delivers a mid-teens returns for us, that say 12 to 14% return. That can be achieved through a coupon and warrants or newly issued warrants from the company if we're working with the company on this. But we're looking to 12 to 14%, which is that's kind of middle of the road for private credit in the lower middle market today. We're not trying to be egregious about it. Our mission in this is to increase the number of ESOPs over time, and deliver returns for our limited partners. We think those two things are not incompatible in any way.
So Brendan, when we've talked in the past, you've mentioned a couple other areas that you're looking to expand into in the future as well. How do you envision Liquidus expanding to include other strategies in the ESOP space in the future?
Yeah. So Fund One will focus entirely on seller note acquisition. We feel that's it is an efficient way to enter into the ESOP world and understand the shape of the ESOP world from the inside. But we certainly have ambition in future funds, to move both upstream and downstream. Upstream, financing original transactions and creating more ESOPs with additionality, like creating more ESOPs and employee owners by providing the debt at the front end. But interestingly, we also want to move downstream. And what I mean by downstream is both be a capital provider, a smart capital provider to ESOPs more generally, to finance acquisitions, to finance growth, to finance initiatives, because we understand how ESOPs work intimately. But interestingly, one of the things that we're really intrigued by, and we haven't solved this by any means, but I think if you look at the ESOP own employee base across the US, there's 2.4 million employee owners out there with north of $1 trillion of plan asset value that they cannot touch until they leave the company, voluntarily or involuntarily or at retirement. That we understand why that is, and ERISA law governs that. We understand that it's a retirement plan, and there are good reasons for that. But if you look at a lot of these workers, many of which are low and moderate income workers, they end up financing big purchases and big needs in their day-to-day lives with things that are way more punitive than perhaps we could solve for. What I mean by that is if you go to a payday loan outfit, you're going to pay an outrageous interest rate to finance a car or buy a used car or put a down payment on a house or something like that. If you already have this asset value, is there not a way to create a financial product that is an unsecured loan against that? We know we can't secure it with ERISA law. That might be changing, we know. But for the time being, unsecured credit is something that we understand. We've done a lot of this in our past, in our careers. And that employee that is an employee owner in an ESOP is a really good credit risk. And so maybe creating an opportunity to provide financing as a financial product, not necessarily as a fund, to help employee owners access some, not all, of that ESOP value to do important things. Put a kid through college, down payment on a house, finance a new car, et cetera.
That's a it's an interesting point. That actually might lead into my last question here, which is when you look out 5 to 10 years within this ESOP landscape, it looks like you did a deep dive to enter it. But if you were to look out 5 to 10 years, what do you think the ESOP landscape is going to look like? What's going to change?
Well, I mean, if we're even partially successful, I think, and one of my goals that I get excited about getting out of bed every day is we got to create more than 6,000 ESOPs. We just have to create more. Like they should be the backbone of the American economy. Employee owners should be everywhere. And 6,000 to 60,000, I think is, maybe that sounds like a moonshot. I would say 600,000 might be a moonshot, but let's get to 60,000. Both financing them on the upfront side, providing liquidity in a secondary market for seller notes that are already out there, and opening up liquidity or partial liquidity to the employees that already have this asset value in their plans. I think if you can show that and communicate that, I think a lot of owners will elect to go the ESOP route or some other employee-owned structure, because it's the right thing to do. It preserves the legacy of the company. And I don't want to bash private equity too much, but a lot of my friends are in private equity, but private equity doesn't need to own everything. And I think we at Liquidus are really focused on let's provide an alternative that doesn't have any friction to it.
Well, they have a
Whether,
big part of the pie already.
they've got enough, right? Like if this all comes true and there's 600,000 ESOPs in the world, I think everybody wins with the exception of maybe, I don't know, 500 to 1,000 private equity managers that aren't going to be able to buy their eighth home. And nobody's going to feel sorry for those guys, right? So again, I think private equity does a lot of great stuff, but I also think its strategy destroys a lot more value in many cases than it creates. And I think ESOPs are a wonderful and effective and really well structured antidote to that. And we're just trying to bring more capital to bear on this because we think it's a great place to allocate capital, and you can generate really great risk adjusted returns here.
Great. Well, this has been a really fruitful conversation. We appreciate you guys being pioneers in the space. There's a couple other funds that are doing what you're doing. The market is not saturated yet.
By any
There's
means.
not
Yep.
there's not enough private capital entering the space to recap and provide liquidity to owners that have taken back these notes that oftentimes can take anywhere from 5, 7, 10 years. And we have found just by being in this business for the past 25 years, a lot of sellers, they monetize, they have fire in the belly, they want to stay with it. But the reality is they love to hit the bid, even if they're leaving a little money on the table to become liquid and walk away. And I think that's really, it's really trying to find the right fit. You want to find the right
Yep.
portfolio company. You want a seller that's ultimately had enough and they're willing to give some of that spread over to a fund like yours. And there's a real need in the community. So best of luck with what you're doing.
Thanks.
We very much appreciate the time today. Sarah, I'll kick it back over to you to close out. But again, Brendan, thank you very much. And I look forward to
Thank you,
seeing you
Keith.
soon.
Yeah, likewise.
Yeah, thank you, Brendan, and thanks everyone for joining today. Look forward to participating again next year in the 8th annual Rutgers Symposium.